2022 has obviously been a tricky but very interesting year for markets, largely because of price and inflation, as we know. 2023 could be equally interesting, but it's probably going to be more a story about growth or potentially lack of. I wanted to talk to Liz Ann Sonders of Charles Schwab, and I follow her on Twitter. She has some very, very interesting insights, and I wanted to pick her brains about what she thinks is the reaction function of the Fed right here, right now, and what they're going to be doing over the next few months as we see this change from a price problem to potentially a growth problem. Hi, Liz Ann, and welcome. And I think I wanted to chat to you because we're at this very interesting juncture at the moment where 2022 has felt a little bit like a price shock, but not yet a true kind of broad-based recession. But it feels like we might be now in a transitions phase coming in towards 2023, where some of this tightening might start to feed through to the real economy. And what I wanted to sort of get your views on is, what do you think the Fed, or what is it that the Fed should be doing right now, and what is it that they are doing?
So I think for the most part, they're doing the right thing. There's lots of debates, and debates will probably go on for years and years about whether the Fed was late to the inflation fighting party, but that's all the counterfactual. There's nothing we can do about what they did or didn't do in the past. At this stage in the game, they want to maintain an aggressive stance until they have convincing evidence that inflation has not just peaked and started to come down, but is on its way down sustainably. So for now, anyway, that keeps them on a fairly aggressive tightening path, maybe with an expected step down in the pace. And I would expect that to continue maybe up until the point where you start to see the kind of deterioration in the labor market that to some degree is a feature of what they're trying to do in terms of bringing inflation down sustainably.
And when you talk about that, you sort of say, well, they may step back from, I suppose, 75 to maybe 50. But this comes to this great debate that everybody's sort of having, which is they're going to pivot. Now, what do you think the market thinks a pivot is? Because I always used to think of a pivot as being reverse engines and cut rates, but it's not really that anymore, is it?
Well, I think that's what was defined as a pivot back in mid-June when you saw the big stock market rally that ensued over the couple of months until mid-August. Personally, I thought that narrative made little to no sense because at that point we weren't at a peak in inflation, and I think the only condition or set of conditions that would be a green light for the Fed to pivot to rate cuts would be much more deterioration broadly in the economy or at least in the labor market, which is why I think that the Fed is still trying to maybe define the difference between a pause, just pulling their foot off the brake, not to then pivot to rate cuts, but to just assess the landscape, knowing full well that there's lags in terms of monetary policy changes and an impact it has on the broader macroeconomy as well as on the labor market. So a pause is in the cards, but I still think a pivot is not in the cards until that combination of much weaker economic growth, more deterioration in the labor market in conjunction with further move down in the inflation data. And I think the Fed is likely, once they get to the terminal rate and pause, whatever that is, I think their inclination is to stay there for a while. So I think a pivot may not be a 2023 story.
And so when you think of that pause, and you're effectively talking a plateau, and at the moment I think Fed funds is still really got quite a distinct pivot in sort of May of 2023. Is it going to be a plateau, or is it one of these things where they might pause, and if things don't go their way, they could actually then continue on the path to potentially tighter rates if things aren't going in the right direction?
The way I think about it is almost with some kind of mirror image symmetry or asymmetry, is if the Fed overshoots, let's say, with the benefit of hindsight, they end up tightening too much, more than was necessary to bring inflation down, and in turn that causes more of an economic dislocation, disruption, more deterioration in the labor market than either was their goal or their hope. That actually would set up the possibility of rate cuts coming sooner, not later. So more front end weakness sets up a nearer term pivot. Conversely, if the Fed undershoots and they pause too quickly, and for whatever reason you get a reignition of inflation and they have to either step back in, that pushes the eventual pivot to rate cuts out into the future. I'm not sure that there really is a perfect scenario where they get it just right in terms of policy. It's just right in terms of inflation continuing to come down with no impact on the labor market. That's always a very narrow hole in the needle that the Fed tries to thread. I think maybe even narrower given the very unique circumstances in this environment, not least being they're battling a 40-year high in inflation. They're not battling the prospect of inflation.
So I mean, it is a real tightrope that they're walking. And as you say, it sort of sounds like it's the choice between a little bit of relief now, but if you really want sustainable growth, you have to actually, cap once and for all prices today. But in terms of the sort of the mechanism that gets that sort of the prices properly down, is it that they need to break employment, as in push employment significantly higher, or do they need to break the equity market because of financialization that would lead to job losses, or is it effectively one or the other or both because they're sort of two sides of the same coin?
I think it's a combination of both, and frankly, on the equity market breaking side of things, as well as breakage outside the traditional financial system or equity market in some of the more speculative areas of the market. The most recent obvious example is what's going on with FTX and crypto. That's, I don't want to say already happened as if it's fully in the rearview mirror, but that is having the intended effect until recently because the rally has aided in loosening financial conditions. But that's been a driver of the tighter financial conditions the Fed wants and believes is necessary to bring inflation down. On the labor market front, again, they would love the Goldilocks or perfect scenario of essentially squashing job openings, bringing down the quits rate without it leading to a significant move higher in the unemployment rate. That's where it becomes really tricky. And I still think that given the call it brown shoots of labor market weakening that you actually already see if you bother to look under the hood of standard measures like payrolls or the unemployment rate, we're starting to see some of those breaks. Whether the Fed can help to engineer that perfect scenario of taking the tightness out of the labor market without causing a significant increase in the unemployment rate, I think that's a much tougher exercise. I think the unemployment rate is going higher from here. Maybe not to an extreme degree because there's still that desire for companies to hang on to, that sort of hard fought, hard won labor. But to expect the unemployment rate to stay at these very suppressed levels, I think that's a bit pie in the sky in terms of a hope.
And how do you think that the Fed is actually viewing the that employment outlook? You talked about the quits, etc. It feels very different from what it was in the 1970s, very unionized, and yet
Right.
underneath the surface, if we look at the job market, obviously we're seeing some of the sort of tech companies shedding jobs, but we are seeing effectively inflation beating wage negotiations coming through in parts of the public sector and certainly some of the old economy. Do you think the Fed has still got that kind of Pavlovian conditioning from yesteryear in the 1970s that if they don't break the labour market, there is this risk that wages do become a spiral like the 1970s, even though a lot of the reasons behind today's higher prices are very, very different from then?
So I obviously can't get it directly inside the head of Powell or other Fed members. I do think that the Fed, definitely Powell, he's a student of history, he's a very smart guy. I think he understands that there are more differences between the current environment in 1970s than there are similarities in terms of what the drivers of inflation are, how systemic they are. You mentioned organized labor and unionization, but you can go into globalization and demographics as being very distinctly different. What I think they're really trying to do as it relates to the environment of the 1970s is avoid the fits and starts of monetary policy that led to two or three times where inflation reignited again, ultimately requiring, as I like to say, Paul Volcker, to pull a Volcker. So it's not so much that they view the conditions in a Pavlovian way as similar, but they want to avoid the starts and stops mistake that helped keep inflation entrenched. So I think that's the important reference to the 1970s, not the background conditions.
And you talked about there's this narrow window where potentially things might go just right, which is if we see inflation coming down quickly enough before we see unemployment really picking up. Do you think that the barn door is already flapping open because of the sort of lagged effect of what we've seen in terms of higher interest rates, and particularly, we've got these mortgage rates which are, it's not so much that they're super high, it's just they've come from very low levels to relatively high levels. And that's if you're talking about interest rates and yields that sound like they're probably going to stay slightly higher than expected and slightly higher than people had expected. Does that mean that it's going to be very hard to avoid some form of recession? But do you think that we could avoid a deep recession?
At this point, with the data we all have at hand, I think the avoidance of a deep recession is more than possible. It's probably the more likely scenario because we don't have the kind of financial system imbalances akin to, say, the 2008 period, where then when housing faltered or imploded, it took the entire global financial system down with it. That is not the case right now. But although I'm a big believer that rate of change in most data in terms of economic data and how it relates to the stock market, rate of change and direction matters probably more than level. I've always said, better or worse matters more than good or bad. But in the case of interest rates, I think level has to be taken into consideration too. And that's where some of the lagged effects come into play. Yes, we've already seen it in the housing market because of the spike in mortgage rates. But when you think about the 0% interest rate environment, negative interest rate environment that's been so pervasive around the globe, not just in the United States, it was a breeding ground for lots of kind of funky things, including lack of price discovery, the keeping of zombie companies afloat, the ample liquidity that then moved a lot of money outside of areas typically offering that liquidity. And I don't think we have yet finish the process of going through that. As the liquidity tide goes out, you see who's swimming naked. So I think whether it's in the private bank market, the credit markets, zombie companies, and the ability to remain afloat because of interest costs, that's where I think the level is already and will continue to come into play, not just the rate of change.
And sort of thinking slightly beyond 2023, but how this plays out, do you see this as being effectively, I don't want to say transitory because that's that horrible debate and it's kind of largely irrelevant, but do you see this as being something which is a reset to a new regime and a new framework, which is interest rates are going to set higher and we potentially have slightly higher levels of base inflation than we've had before? Or do you see this as being something which was a breakage in the system, a bit like we had in the 1940s post-war, where things got out of line, but eventually after 4 or 5 years, they got back into line and things started to normalize again. Do you think that we are on potentially a new multi-decade framework, or do you think that this is just an unusual experience because of COVID and then because of other issues and a little bit of malinvestment maybe over the last 10 years? But once this has worked its way through and those cycles have realigned, we'll move back to something like before, or is it completely different now?
No. I think it is quite a bit different. I don't think we go back to the environment that preceded the pandemic, the 2 decades or so, often defined as the period of great moderation. I don't think that is in any way the condition we're going back to. Now, it is certainly possible that on the way down, components of inflation could overshoot on the downside, and you're already seeing disinflation, if not even a little deflation, in certain segments that overshot on the upside. But I think ultimately, when inflation settles, it probably not only settles at a higher level than was the case during the Great Moderation, but it probably comes with more ongoing volatility. As a result, I think they're pretty much gone for now, and maybe for some time, is the era of 0% interest rates and multi-trillion-dollar balance sheets on the part of the Fed. That's not a bad thing in the sense that we actually have a risk-free rate now. There's income and fixed income. I think there's greater price discovery. There's a reconnectivity of fundamentals and prices. I think it's actually to the benefit of the average stock versus the market having been so cap weight oriented. I think it's a benefit in terms of an eventual positive capital spending cycle. So it's going to be quite different, but not all bad relative to what was the case before. I think capital might lose a little bit of the weight or power as in GDP with a pickup a bit in terms of labor's weight and power. I don't say that with a political bent to it. That's just the way cycles work. It has to do with demographics and lots of other things going on globally, not just in the United States. So I think there are a lot of interesting and important, more secular shifts that I think we're going through the process of getting to that, again, are some of them, I think, bring some sunshine into the mix.
And so just sort of finishing off, in terms of what we should think about this sort of investment environment going forward, it sounds like this is going to be an environment where effectively there's going to be more opportunity, more dispersion, because we've been used to sort of tech, big cap getting mega cap, and sort of flows being very, very channeled. It sounds like capital will have more opportunities, maybe smaller opportunities, but more opportunities and a greater dispersion of opportunities.
And a reconnection between fundamentals and prices. Analysis really didn't have to go very deep in a world where passive was so dominant and you had these cap weighted indexes driven primarily by a small handful of stocks. Decision making was fairly easy, particularly if you were benchmark oriented, and maybe it becomes a little less easy if you're not in a perma bull market where you just put all your money in an S&P index fund or ETF and ride to the moon. But I do think it provides an opportunity for differentiation, for active to be living on a more or playing on a more level playing field with passive, and the fact that you have this reconnection between fundamentals and prices across lots of asset classes, not just specifically the equity market. I think we're in some version of a rolling recession, and I think there's probably more pockets to come that will be hit. But there have been positive offsets along the way. And so to me, that's best case scenario is this just continues without the bottom falling out all at once. I view that, the rolling recession scenario, as more the best case scenario versus the typical language of a soft landing.
So Liz Ann was talking about what is quite a tricky environment for the Fed. It's that very much a tightrope where we've seen what she calls these rolling recessions, where it's moved through different parts of the economy without capturing the whole of the economy in a true recession. There is a chance that next year we might avoid a true recession, at least a really deep recession with lots of duration, a lengthy one that hits all parts of the economy. But it feels that we are going to get a slowdown, and it feels like the Fed does want to make sure that before they take their foot off the accelerator, in terms of the rate hikes that they're doing, they want to be sure that they have capped price. And it seems like the most likely way that they'll do that is that rather than have a true pivot where they actually reverse engines and cut rates, what they'll probably want to do is see them plateau and hold them there until they're absolutely sure. Now, that obviously means that it's going to be probably quite a tricky time for markets. But as you heard there, the difference between now and the last 10 years is we're probably going to see a lot more dispersion, a lot more opportunities for investing, rather than having to funnel all our money into one trend and one trade, which was obviously that sort of tech and low price of capital trade that we saw for much of the last 10 years. So the next few years could be very interesting times for investors.